to pay extra attention to that market and make sure that you are represented in it with some high quality stocks and some physical and things like that. But unless you're a professional trader, you don't want to be betting large amounts of money on the collapse of the COMEX or anything like that. You want to be buying a good quality ETF that represents a lot of the silver miners or something like that, and maybe some silver eagles if you can get them or something like that. You want to be looking at physical silver and high quality miners, not in any circumstance futures contracts. Well, a couple of things. First is it's hilarious to be talking about precious metals as crashing like all the way down to 4,900 for gold and 72 for silver. You know, those would have been paradise prices just a couple of years ago. So it's a measure of how wild the precious metals bull market has been, that it feels almost catastrophic to be at these, you know, historically incredibly high prices, just much lower than in the last few months. And first of all, it's to be expected that when you have a huge run like gold and silver have had in the last year, that you get a correction. That's just normal. There's an awful lot of people with profits to protect, and selling is one way you protect your profits. So a correction is to be expected in this kind of a bull market, and they happen in all bull markets. And you've got the ever-present manipulation going on out there, where COMEX raises the margin requirements to an unreasonable level, and that pushes down the price, or that dries up activity in the futures markets and causes the price to go down. That's happening too. And now, right this minute, this week's crash is mostly because the Chinese markets are closed because of a holiday, and they don't reopen again until the 24th. Today is the 17th, and they open again in 6 or so days. And that just leaves the US-based futures contract speculators to play in this market, and they've decided to smash gold and silver, as we expected, because the COMEX and the other exchanges here are running out of physical silver. So they really need to strangle activity, especially the kind of activity where people are standing for delivery on futures contracts. And so this is a chance sent by heaven for them to lower the price of silver to the point where it's not an issue. You know, they're not going to be drained dry in the short run and then have to default. So all of that stuff is going on, and most of it will probably reverse out once the Asian traders come back in, because they're basically buying physical for industrial uses. And, you know, the solar panel guys still need the silver they need. The electric car guys still need it. The world's military industrial complexes out there all need silver for their missiles. And so physical is still going to be in demand. The price pressure will probably be to the upside once China comes back online, and we'll probably forget about this week. You know, it'll just be a squiggle in the context of a long-term bull market. So the question is, should we be bottom fishing here? It's just so hard to call these things, these prices, the bottom. I looked at SIL, the big silver miner ETF, thinking maybe I'll grab some cheap shares here, but they're still not cheap. You know, they're double or triple where they were a year ago. So bargain hunting just doesn't feel right at these price levels. So I'm just sitting on the sideline waiting for all this to play out. You know, I think there's a lot of people out there who missed the past move, the past year, and they've been kicking themselves for it, just sitting on the sideline while silver goes up and up and up, and all the people on X brag about, how well they've done and everything. Well, this is a chance, maybe, to grab some of those shares that they missed. So I think there's some buying incentive out there right now for people who missed the boat and who want to get back in, and that's probably supporting these shares to an extent. I mean, it won't continue to support these shares if silver keeps dropping, but right now there's probably a justification on the part of a lot of people right now to pick up some of the shares that they missed at least 20% off, because they missed the 200 or 300% move in a lot of cases, but at least they can buy in when the chart is heading down, and maybe get back some of what they lost. I don't know. We'll see. But I think there's the real possibility that that's the case out there.
Short-term turbulence often reflects market structure rather than fundamentals. Futures exchanges can raise margin requirements, squeezing speculative activity and cooling prices temporarily. At times, thin trading conditions, such as major Asian market holidays, leave Western futures traders dominating price discovery. That imbalance can exaggerate downward moves. Meanwhile, concerns periodically surface about physical supply levels on exchanges like COMEX. If fewer traders demand delivery, pressure eases. But once global physical buyers return, particularly from Asia, where gold and silver demand has surged in recent years, pricing dynamics can shift quickly. Structural volatility does not necessarily invalidate the broader supply-demand picture.
It could be, it could be that, there's so many rumors about who has what out there, how much short JP Morgan Chase is or how long they are and everything. And I don't really have any good information on those rumors. So I don't know who's short or who's long, but it's completely possible that there are some big shorts out there who are desperate to be able to get out without being crushed. And that the manipulation that's going on now is at least in part due to that big short position out there and is designed to help the big shorts. We'll have to see. I really don't know. And I have a lot of trouble with these short-term moves because they're very hard to predict and nobody really knows anything. Nobody has perfect insight into what the guy's either manipulating or going in big for industrial reasons or whatever are doing in the moment. And I think that it's a lot psychologically healthier to be looking at the long-term movements or the long-term fundamentals for these industries. Silver's in shortage right now. We don't produce enough to cover the silver that's being bought. And that's been that way for several years. And it's only increasing. You've got these new batteries coming online that use more silver than the existing electric car batteries. And today's next generation solar panels use more silver than the last generation. So there are a lot of reasons to expect the silver deficit to grow and to turn into panic buying at some point. And that's the fundamental fact of the silver market. We just don't have enough silver. And there is massive demand for it on the horizon. And historically, that's the kind of thing that leads to big increases in price. So if you stay focused on that and keep dollar cost averaging and using lowball bids to get things as cheaply as possible, then you're okay financially and psychologically, because otherwise these what are going to look like squiggles 2 years from now, but these really massive moves in the moment will drive you crazy. And what you don't want is to be driven insane by your money. Your money should be working for you and should be lessening the stress in your life. But if you try to trade something like silver, try to go in and out, then your stress level just goes through the roof because silver will kill you, or any kind of highly volatile market. Like if you try to trade in and out of AI stocks, which a lot of people do, a lot of people go in and out of NVIDIA and stuff like that. Well, sooner or later, you're going to be driven insane by that because the stress will just become overwhelming because you'll be so wrong with so much of your net worth. So just don't do it, add gradually to these sectors and these commodities that have really good long-term prospects, like copper. The copper story is great. We're going to need, there's one speech that keeps showing up on YouTube where somebody big in the copper space says, we're going to need to find as much copper in the next 18 years as we found it in the previous 3,000 years. And we aren't going to be able to do that. So when you have those kinds of fundamentals in the market, you should be very comfortable just gradually adding to your positions. And of course, gold. Gold is obviously something that has phenomenal long-term prospects because the world is inflating away all the big fiat currencies. And when that happens, historically, everybody piles into gold. And we'll probably have to go back to a gold standard. We'll have a currency reset that is, possibly a gold standard, or at least will involve gold in some way. And when that happens, it has to be at a much higher price. So there's gold's fundamentals. It's got to go up to $15,000 or $20,000 an ounce to be able to make the next global currency system possible. So, same thing with gold. Add gradually. You don't have to play the squiggles. Just buy what you can when you can, and let the fundamentals play out.
Silver's long-term narrative is rooted in scarcity. Global supply has struggled to keep pace with industrial demand for several consecutive years. Solar panel manufacturing, electric vehicles, advanced batteries, 5G infrastructure, and defense applications all rely on silver's unmatched conductivity. New generation solar technologies use even more silver per unit than prior designs. According to industry estimates, the silver market remains in structural deficit, with above-ground inventories tightening. Unlike fiat currencies, silver cannot be printed. When industrial users require metal to keep production lines moving, price becomes secondary to availability, a dynamic that can produce sudden and explosive upside.
Oh, yeah. Well, that's part of the silver shortage story, that the industrial users of silver are buying as much as they can at whatever price they have to pay. And that is leading to a lot of commodities, or futures contract players who didn't used to stand for delivery to demand physical silver. And yeah, the COMEX is being drained dry, although what's happening this week might help them accumulate a little more silver and delay the inevitable. But the time is coming out there when the futures markets, it used to be just places where people gambled without ever expecting to get something as unwieldy as physical metal, as part of the process. Now they're starting to demand physical metal. And that's leading to the possibility of a default. And as you said, if they settle with cash, they'll say that's not a default. They'll say, well, we gave you cash, we gave you the value of the silver, but it will be seen as a default, because if they had the metal, they would hand the metal over. And once that happens, you get the prospect of panic buying out there as people realize that they're out of silver and they need silver. If you're an electric car maker, you need X amount of silver in the coming year to keep your factory running. And so the price of silver becomes irrelevant when you're thinking in terms of availability. So you need this thing that keeps you from shutting down your factory and losing billions and being the laughingstock of the industrial world. So you pay whatever you have to pay. And if we have the metals exchanges start to default, then you have the prospect of that kind of a market. And you've got analysts out there saying, oh, silver $500 an ounce this year, and I would never make that kind of a prediction, because that's a hell of a prediction. But in markets where you have extreme shortage and that turns into panic buying, then you sometimes get crazy price action. That happened with nickel a lot. And everybody should remember that, because, and I'm pretty sure it was nickel, right? Where it went straight up.
2022.
Okay. Yeah. And so there were a lot of people out there who had long futures contracts in nickel who were rich on paper. They thought they just did the one trade they had to do in their lifetime because nickel went up so much. And then the exchanges just canceled the contracts. They just said, this never happened. We're going to give you all your money back. And there were no massive lawsuits, nothing happened in the Supreme Court or anything with that. It just happened. And everybody who was wrong got away with it. So stuff like that, knowing things like that can happen means that we should consider that possibility in commodities markets going forward, because there are quite a few commodities markets where there are potential big shortages out there. Copper's one, silver's another, gold, who knows? And there are lots of rare earth elements and things like that trade, but I can't pronounce their names. I have no idea what their fundamentals are, but their fundamentals are probably pretty favorable as we run out of all this stuff. So there's the potential for a lot of action in the futures markets. And, there's no way to know where it starts and what the final result is, but it could be pretty chaotic. And the chaos is probably going to be to the upside. So, it's a thing to pay attention to. It is not a thing to bet your life savings on. You are not that guy who's making big bets on gold out there. So regular people should always be cautious, even when there's a talking head saying, "Oh, the COMEX is going to collapse and there's going to be panic buying," like I'm saying right now. Don't take that as a signal to bet your retirement on. Take it as a signal to pay extra attention to that market and make sure that you are represented in it with some high quality stocks and some physical and things like that. But unless you're a professional trader, you don't want to be betting large amounts of money on the collapse of the COMEX or anything like that. You want to be buying a good quality ETF that represents a lot of the silver miners or something like that, and maybe some silver eagles if you can get them or something like that. You want to be looking at physical silver and high quality miners, not in any circumstance futures contracts.
History offers cautionary examples. In 2022, the nickel market experienced extreme price spikes that led to canceled trades and exchange intervention. Such episodes reveal how fragile derivatives markets can become under stress. If large numbers of futures holders demand physical delivery in a tight supply environment, exchanges face enormous strain. While a formal default is unlikely in conventional terms, cash settlement instead of metal delivery could severely undermine confidence. In that scenario, panic buying becomes possible. These outcomes are not guaranteed, but they illustrate why structural shortages in critical commodities deserve close attention.
Well, first of all, there's always a whale out there doing something crazy that makes it look like they have inside information. And after the fact, you frequently don't hear about them anymore, because their bet didn't pay off and they actually didn't have insider information. The world is full of people who are ready to just roll the dice. And the world is full of a lot of rich people. So sometimes those two groups intersect. And you see a giant bet being placed on something. Of course, sometimes big bets like that do pay off. There were apparently a lot of short bets on the airlines right before 9/11. And there's stuff like that, both before that and after that. That does make it look like somebody had a lot of inside information. But if somebody's betting on gold tripling in 1 year, then in effect, they're betting on World War III breaking out, right? Which means they're part in some way of the military industrial complex, or somebody, some general somewhere is funneling some money to his brother-in-law who called up somebody in China that he knows and said, "Hey, do this, we'll reimburse you and everything." And that's terrible. We do not want gold to go to 8,000 or what was it you said? Gold would triple, right? So we don't want gold to triple in 1 year, because that means something horrible happened. There's no good thing out there that will make gold triple unless it's somebody, some big government declaring that they're on a gold standard with gold at 3 times today's price. But no government's going to do that unless they're in crisis. Because going back to the gold standard takes away the power to create money out of thin air for governments, and they're not going to give that up unless it's the least bad option on a list of really horrendous options. And we're not there yet, We still have options for governments going forward that don't involve them setting up a gold standard and giving up the power to create money out of thin air, and so they're not going to do it yet. So if they're not going to do it, if it's not a government setting up a new gold standard, then it's World War III. And a horrible start to World War III. It's somebody nuking somebody, and the whole world deciding on which side they're going to be on in the coming fight, something like that. So let's hope this guy's wrong, or at least that he's wrong in terms of magnitude. It's fine if he's right directionally and gold goes up by 50% in the next year. That would be a huge move. and would imply some bad stuff, but not catastrophic, horrendous bad stuff necessarily. So, we can hope he's right to a point, but actually he would still lose all this money because he's betting on a tripling, right? So, we absolutely categorically hope he loses, but if he's kind of right directionally and gold goes up some from here, that's fine. That's to be expected, and that's just fine and dandy for the stackers out there. And we should be hoping that something like that happens. But anyhow, yes, there are lots of crazy things placed in the world, and we should also be ignoring them for the most part.
But John, just think of where that takes silver.
All right, if gold triples, then we get that $500 silver easy, right? Yeah.
Mm-hmm.
So,
I think so,
yeah. See, silver there are fundamentals for silver that could make it go way up because it's an industrial metal as well as a monetary metal. So it has two things going for it, and it's possible that we see a big, huge run in silver. But that also probably from an industrial angle is a bad thing because it means that a lot of things that we buy are going to get way more expensive because of the silver content in those things, and that's great if you're massively long silver, okay? But it's for the 99.5% of the population who is not massively long silver, then that's kind of inflationary. It makes the cost of living go up, and it's also something that we shouldn't wish on other people, even while we're making money.
Gold's strength reflects deeper monetary forces. Global debt levels continue climbing, major economies run persistent deficits, and central banks, particularly in Asia and emerging markets, have accelerated gold purchases to diversify away from dollar exposure. Inflation remains structurally embedded in many economies despite tighter policy cycles. Gold historically performs well when confidence in fiat systems weakens. Some analysts speculate about far higher long-term price targets in the event of monetary reset scenarios. While extreme predictions often exaggerate risks, gold's role as financial insurance in uncertain times remains widely recognized by institutions and private investors alike.
Oh yeah, gold is definitely a hedge against chaos. And part of the reason it's going up is because the world has gotten more potentially chaotic going forward. Everywhere you look, there's something really wild happening out there, and so gold is a thing you buy in that kind of an environment. But I don't get the sense that right now, for most people, the world is more uncertain than during COVID. That was half the population thought we were going to die of a plague, and the other half thought they were going to be killed off by the first half. And so that was a very uncertain time. And it's not like that now. So I don't know what their metric is. I would think that the only way you would get a record high uncertainty measurement now is if you're that same guy betting on gold tripling because you know when World War III is going to start. And otherwise, I wouldn't pay attention to this thing either because, extreme uncertainty is absolutely coming. We've got the biggest financial crisis in human history headed our way. We probably got a lot of geopolitical consequences of that gigantic financial crisis, but it's not happening right this minute. Most people are going through their lives pretty normally right now and are not in panic mode. And so that chart implies a lot of people in panic mode, and we're not seeing that right now. So I would not give that a lot of credence. And I would, again, focus on the high quality names in the precious metals market that you can buy, and the relatively cheap, recently deal on silver that you might be able to buy if you find a coin dealer who has a lot of silver eagles in inventory, something like that. Focus on that, and don't let the pretty constant drumbeat of gloom and doom that's out there. I mean, that's legit, but it's not happening right this minute. So don't let it dominate your psyche right now, because you should be focusing on the longer term horizon in which you're building resilience and shifting your finances away from financial assets and into commodities and other hard assets. These are things you can do in the moment that don't require the world to end tomorrow and don't force you to stress out over things that you can't control and you really don't understand.
In volatile commodity markets, discipline often outperforms drama. Attempting to trade every swing in silver or gold can amplify stress and risk. Instead, many long-term investors focus on gradual accumulation of physical metals, diversified mining equities, or broad-based ETFs. Similar structural narratives exist in other commodities such as copper, essential for electrification and global infrastructure. The key is resilience, not panic. Corrections that appear catastrophic today may look minor in hindsight. By emphasizing fundamentals over headlines and avoiding excessive leverage, investors can position themselves thoughtfully within what may still be an unfolding multi-year precious metals cycle.